If you're incorporated, you're a business owner, or you're a professional, here's a retirement truth that no one talks enough about. RRSPs might leave you with less than you think because of taxes, clawbacks, and forced withdrawals. But what if there was a way to build a tax-efficient income stream, access capital when you need it, and protect your estate all in one strategy? Hi, my name's Laurent Munier, and I'm a partner and advisor here at Safe Pacific Financial, and in today's video, I'm going to break down how the Insured Retirement Plan helps Canadian professionals turn life insurance into a retirement income engine. Now, here's why RRSPs might not be enough if you're an incorporated professional or a business owner. So RRSPs, which is your Registered Retirement Savings Plan, is one of the most recommended retirement tools in Canada, and we recommend them too. If you're high income, you're a high income earner, you're incorporated, or you're a business owner, RRSPs could fall short when it comes to building a fully efficient and flexible retirement plan. Now, here is why relying solely on RRSPs can be problematic. So, while the RRSP gives you that upfront tax deduction and it gives you the tax-deferred growth, every dollar that you withdraw later or in retirement is taxed as ordinary income at whatever your full marginal rate is at that time. So this means that if you've built up a big RRSP and you're in a high tax bracket later, you could be handing over a significant chunk of this retirement savings to the CRA. So additionally, RRSP withdrawals are counted as taxable income, which can result in a clawback of what's called your old age security or your OAS, if your net income exceeds whatever the government threshold is, and that's whatever it is today and whatever it is in the future. So this effectively punishes you for saving and earning more. Then, at age 71, you have to start taking money out. Your RRSP has to be converted to a RRIF, right? A Registered Retirement Income Fund, or just a retirement income fund. So then you're forced to withdraw a minimum percentage every year, even if you don't need the money. So this creates a situation where you're going to get taxed on money that you might not need and that you might want to keep growing inside the RRSP, or you might want to keep it in investments so that you could pass it on to your kids later. Then you have market volatility, right? Something that is definitely more stressful and not less stressful as you're approaching or entering retirement. A market dip in those early retirement years could have a huge compounding negative effect on the longevity of whatever your retirement income you thought you were going to get. Because of these issues, more Canadians are turning to alternative retirement funding strategies. And one of the most effective is what's called an Insured Retirement Plan, or an IRP. It offers a combination of tax-sheltered growth, access to capital without triggering income tax, and a tax-free legacy for your family or for your corporation or your other shareholders. So if you're looking to supplement or even replace a traditional RRSP with a smarter, more tax-efficient plan, the IRP could be your next move. So now, what is an IRP and how does it work in Canada? The Insured Retirement Plan, it's a powerful tax-efficient retirement income strategy designed for Canadians who want more flexibility, more security, and more control than a traditional plan like an RRSP or pension. And it actually works really well in conjunction with. So it's particularly attractive if you're a high income earner or if you're incorporated, whether you're an incorporated professional or a business owner. And probably you've maxed out your registered accounts, your RRSPs or TFSA, and you're looking for more ways to grow and access retirement capital without triggering a ton of tax. So at the core, the IRP uses a permanent life insurance policy, which is typically a participating whole life insurance policy, as both a wealth building asset and as a retirement income source. So here's how it works in kind of a step-by-step way. So number one is you need to apply for and qualify for and purchase a permanent life insurance policy. And you need to fund it over time using either your personal dollars or your corporate after-tax dollars, depending on how you structure the policy. We structure these policies to maximize the cash value inside the contract and to make it grow as big as possible. So number two is the cash value will grow tax sheltered inside the policy under normal Canada tax rules. So yeah, life insurance grows tax deferred inside the policy. This is Regular Income Tax Act. This means you can accumulate the wealth over time without having to pay annual taxes on the investment gains, on the dividends, and on interest. Number three, when you get to an age of retirement, so in this case, in order to do this, it depends, there's going to be some bank lending and it depends on how old you are. Usually it's around 55. But once you reach this retirement age or any time that you need to access the liquidity, you can borrow against the policy's cash value. And you do that in one of two ways. You do it either through a policy loan, which is you're borrowing directly from the insurance company that you have your policy with, or this is more often what we do. Number two is you have a collateral loan from a bank. So you take your policy to a bank. You say, I have this much cash in the bank. I want to leave this as collateral. You give me a loan. So the bank has different names for these loans. We're talking about Insured Retirement Plan. That's not a name that I invented. That's a name that banks call these types of loans, an IRP. Another one that they do when you're borrowing before your retirement, it's called an IFA, an immediate financing arrangement. They're both very, very similar, and they're both borrowing from a bank based on the cash value of your insurance policy. Then number four is that the funds that you're borrowing from the bank are tax-free because loans are not income. So you can use this money in retirement. You can fund your lifestyle, you can invest, you can give, you can use it for your business purposes. There's no mandatory thing that you have to do with it, and there's no mandatory withdrawals, and then there's no tax drag on this kind of stuff. And then five, eventually, when you pass away, it's going to pay out a tax-free death benefit from the insurance policy, which will repay the loan. And then the remaining balance, depending on how you structure it, either pays out to your corporation in a tax-free way, or it could pay out directly to your beneficiaries in a tax-free way if you own it personally. If it's corporate and the money pays out to the corporation, it creates what's called a capital dividend account, or a CDA. So whatever the death benefit is minus your adjusted cost base can then pay out through the CDA to your beneficiaries. So this allows your estate to receive the money tax-free, and they can do whatever they want with the money. So you can think of this IRP, this Insured Retirement Plan, as sort of like a personal pension or a pension alternative, and it offers that tax-sheltered growth similar to an RRSP. It ensures you get tax-free access to capital similar to a TFSA, and you're getting that money through loans. And then it's got a built-in estate plan that has a guaranteed tax-free payout. So this Insured Retirement Plan, it's ideal for Canadians who've outgrown traditional retirement vehicles and they're looking for a smarter and more controlled way to fund their retirement. So why would you choose an Insured Retirement Plan over an RRSP in Canada? Many Canadians automatically will think of the RRSP as your go-to solution for retirement. But it's not always the most tax efficient, and it's not always the most flexible option. So an Insured Retirement Plan offers a powerful alternative to this if you're a high income earner, if you're incorporated, or if you're a business owner and you want more control over your retirement income and your long-term wealth. Both an RRSP and an IRP, an Insured Retirement Plan, offers this tax-deferred growth inside whatever the investment is. So in the RRSP, it's in your investments, and in your IRP, it's inside this life insurance policy, meaning that the investments or policy, the cash values can grow without being taxed every year. But that's where the similarities end, right? With the RRSP, any withdrawals are fully taxable as income when you retire. So this can push you into a higher tax bracket. This could trigger an OAS clawback, an old age security clawback, especially if you've accumulated significant savings. The IRP, on the other hand, provides tax-free access to the capital because you're borrowing the money. You're getting it either through a policy loan or through a bank loan. And these loans are not taxable income under Canadian tax law. And then this means that you can access these funds without increasing your declared income, with avoiding the OAS clawbacks, and you keep more money in your pocket. RRSPs also have mandatory withdrawals once you hit age 71. You have to convert it to a RRIF. The forced distribution could exceed what you actually need. And actually, we have clients that are hitting 71 and they don't actually need the money, but they have to take it out. So now they're paying tax on this and they're making good money. So they're losing like half to income tax. So this is definitely unnecessary, but there's nothing you can do about it. So the IRP, in contrast, it gives you full income flexibility. So you decide how much to take out every year. You decide when to take that out based on whatever your cash flow needs are at that time. I don't know what your cash flow needs is going to be when you're 71 years old. So I'm not going to have a forced withdrawal set on you. Another big thing is the market volatility. This is a big risk with RRSPs. So your portfolio value in your RRSP can drop at the worst possible time. And really, studies show that the worst possible time for your investments to drop from a retirement standpoint is in a few years before and a few years after retirement. If you get a drop then, it has like a devastating effect over your portfolio for the rest of your life, because just as you're starting to withdraw it. But IRP, on the other hand, it uses a permanent life insurance policy that has guaranteed cash value growth, meaning the retirement capital is shielded from market swings. It's not invested in the market and it grows predictably year over year. And any cash that hits that account, so once it grows, the cash values, then that becomes immediately vested and it'll never go down. So these things only go up, they never go down unless you withdraw, of course. And then a worst case scenario is they would go flat, that they don't issue a dividend in the future and it doesn't grow. But in the RRSP, depending on what you're invested in, it can go up and it can go down with the market. So you've got that risk. Now, finally, there's the estate part, right? So on the estate planning, when you pass away with the RRSPs, that full balance of whatever's left inside your RRSP gets added to your terminal tax return and would be fully taxed as income unless you set it up as a transfer to your spouse. But your IRP, your Insured Retirement Plan, would pay out tax-free because it's a life insurance death benefit. The death benefit pays out to the beneficiaries tax-free. So depending on how you have it set up, you probably have this in your corporation or like a holding company or a trust, and it would pay out to that entity tax-free. And then what happens is the benefit will create a capital dividend account minus whatever your adjusted cost base is at that time, which allows then this money to flow to your estate or to your shareholder beneficiaries without paying tax. So the bottom line is your IRP gives you more control, better tax efficiency, and a built-in estate benefit. So if you're a Canadian and you're looking for retirement strategies that are bigger than the limitations on government registered plans like TFSAs and RRSPs, an IRP is a great alternative to that puts you kind of more in control, more in charge of how much you pay yourself, how you pay yourself without losing a ton of money to tax. Sounds good? So how does it work? Here's a step-by-step on how to set up the Insured Retirement Plan for yourself in Canada. Like, this is definitely one of the most powerful and tax-efficient retirement strategies, but it works for when you're a high income or you're incorporated professional or business owner, because it combines that security of the permanent life insurance with the flexibility of the tax-free access to the capital, which makes it an excellent alternative to traditional retirement savings like an RRSP or TFSA. And here's like a very simple walkthrough of how it works. So number one is you need to set up the participating whole life policy that's going to underpin this whole thing. So you want to set it up with a Canadian life insurance company. The ones that we generally work with for this kind of thing is, say, like Manulife, Sun Life, Canada Life, Equitable Life. Then you're going to fund the policy over time with regular contributions. So again, this will depend on your financial situation, but really the clients that we're working with, you're starting with like a minimum of say $25,000, $50,000 annual savings into one of these things, and you're doing that for at least 10 years. This isn't something that you would set up like the year before you want to retire. You want to set this thing up minimum 5 years before, but really better to have it like at least 10 years before. So you want to build up the cash inside the policy so that you can actually access it later. But really, the numbers depend on your current situation, on your income goals, on your tax goals, on the money that you have right now. And then when you're funding the policy, you've got the policy set up and you're funding it, you're either funding it personally with money that you have, or you're funding it through your corporation, which is usually going to be some sort of holding company. And then there it'll be funded from retained earnings, or if that holding company continues to earn money over time. Then as you're funding the policy, that cash value is going to build up inside. And the cash value is going to grow on a tax-deferred basis, both from that dividend and from you paying premiums next year. Unlike investments that are based in the market, those go up and down and they fluctuate. The cash value inside the policy is going to grow predictably and securely. And then it's going to grow usually from an annual dividend from the insurance company's participating account. So over the time that you have the policy, so I'm saying minimum 10 years, 20 years, whatever, you can have hundreds of thousands or millions of dollars inside there of accessible capital. And you haven't paid any tax on the growth because you're not withdrawing the money. And then once you reach whatever your retirement age that you want to be, so anyway, you're starting around 55 for this strategy, but you can retire at whatever age you want. you can begin to access the policy cash value without triggering taxable income. So instead of withdrawing funds from the policy, you use the policy as collateral to secure a loan at the bank. And so this is key because the loan is not income. So the CRA isn't going to charge you taxes on getting this loan from the bank. Then you use those borrowed funds to do whatever you want, right? You're going to live your retirement life. And you can technically keep your personal income low because you're just going to be living off of loans. So this doesn't affect your OAS clawbacks, and it doesn't increase your marginal tax rate because you're not receiving income. So then these tax-free loans can do, generally you're funding a retirement lifestyle, can cover for travel expenses, medical expenses. You can invest in other opportunities. You can supplement a pension plan. You can supplement other retirement accounts like RRSPs and TFSAs that we talked about without having to sell assets, without having to liquidate the investments. And your policy, the cash value is going to continue to grow because you're going to receive the dividend, and your death benefit's also going to continue to grow because of the way that we structure the policy. So eventually this is going to go, for most of our clients, this goes to their kids. Some people don't like their kids, and this could go to whoever else that they want. But then when you pass away, so what's happening is as you're borrowing this money, you're borrowing it from a third-party bank. And because it's set up as what's called an IRP loan, an insured retirement loan, you're taking these loans every year and you're making zero payments on these loans. And why is the bank going to let you do this? This is one of the only loans where banks don't care if you made payments on it. And because it's secured by the life insurance. The bank knows that eventually one day you're going to pass away. And then when you die, the insurance policy is going to pay out tax-free to either to your estate or to the corporation or to your beneficiary. And then whatever loan you've built up is going to get paid out from that death benefit. And then whatever's left is going to pay to your beneficiaries. Completely tax-free to everyone, tax-free to the bank, tax-free to your heirs. And then when you're structuring, like if it's inside your corporation, there's one extra step. It pays out first to the corporation. It pays out tax-free. You pay out the loan. That tax-free death benefit creates a capital dividend account credit minus whatever your adjusted cost base is at the time. And then this allows your company to pay out the beneficiaries completely tax-free, so they don't have to pay personal income tax. So when you have this insured retirement plan or IRP, you can generate reliable retirement income during your lifetime while also building a tax-free legacy for your heirs. So this is really a strategic way to turn the insurance into a sort of alternative private pension plan, which is really good for Canadians who want that flexible, tax-smart retirement without a lot of government restrictions. So some of the tax advantages of having this insured retirement plan. So this is one of the most compelling reasons that you're using the IRP is the powerful suite of tax advantages that it offers, right? Especially when you're comparing it to traditional retirement savings vehicles like your RRSPs or mutual funds or even non-registered accounts like stocks and things like that. The IRP is specifically designed to minimize your tax exposure during your lifetime and to maximize how much wealth gets passed on to your family or to your estate. And here's how it works from like a tax planning perspective. So number one is you have the tax deferred growth inside the policy, right? So the cash value inside a participating whole life policy grows tax deferred under Canadian tax rules. So this means that the money inside the policy accumulates over time without being taxed every year, which is, again, this is similar to the RRSP like we talked about, but you don't have the contribution limits and you don't have the mandatory withdrawals at age 71. So this allows your wealth to compound more efficiently over time, and it allows it to compound bigger, especially if you've already maxed out your RRSP and your TFSA contribution room, which most of our clients have. If you're incorporated, you own a business or you're an incorporated professional. So say you're like a partner lawyer at a law firm or you're a partner accountant and you're incorporated, or maybe you're a consultant or you're a software engineer. We've got tons of these kind of white collar kind of incorporated professionals. This offers a huge opportunity to grow your funds in a tax sheltered way inside a holding company. Number two, you get this tax-free retirement income through the policy loans or through collateral loans, right? So when it's time to retire, the IRP allows you to borrow against the policy cash value. So you're doing this through a secured loan at a bank, which would probably be set up as a line of credit. It depends on the bank. They do it like each bank does it a little bit differently, but basically this does it without triggering any taxable income, which is the most important part. And then the funds are considered loans. They're not withdrawals and they're not income. So they're not treated as income. So you don't pay tax on it. And then this enables you to enjoy a steady stream of tax-free retirement income while keeping your reported income low. So you don't get any sort of OAS clawbacks. You preserve your age credit. You potentially qualify for other income-tested government benefits. And then 3, you get a tax-free death benefit to your family or to your corporation, depending on who's holding the policy, because the life insurance part of the IRP pays out this guaranteed tax-free death benefit sometime when you pass away. So this lump sum will pay out to either your beneficiaries, to your estate, or to the corporation, depending on how it's set up, without being subject to income tax. This ensures that you get a clean, efficient wealth transfer to whoever your beneficiaries are, or to your family, to your legacy, which helps to offset final tax liabilities. It skips probate complication, and it transfers the most amount of money, and it preserves your estate's net value, right? If you're holding it personally, that full death benefit pays tax-free. If you're holding the policy corporately, it pays to the corporation. It creates a capital dividend account minus the adjusted cost base. That amount can then pay out tax-free to your shareholder beneficiaries. So let's talk about this. Number 4, your capital dividend account. And how does it get credited for the policy that's owned in your corporation? So when you own the policy in your CCPC, your Canadian-controlled private corporation, generally we're doing this inside your holding company, that death benefit generates a capital dividend account, or it can increase your capital dividend account. And then the amount that it does that by is whatever the death benefit is minus your adjusted cost base. So anything that's higher than your adjusted cost base is going to go and create CDA or increase CDA for you. So this allows the corporation to pay out a tax-free capital dividend to whoever the surviving shareholders are. And typically through an estate plan, this would be your spouse or your children or your estate. And this is one of the only legitimate ways to move money from the corporation to a shareholder in a tax-free way. And it's a key reason why incorporated Canadians use IRP as part of their estate plan and as part of their succession plan and as a big part of their retirement plan. And then number 5, you have potential tax deductibility of some of the loan interest. So if you're using this IRP system and you're leveraging the policy to invest into income producing assets, the loan interest may be tax deductible, right? Because you're borrowing to invest. So, you don't have to spend your retirement income just on lifestyle. Like you're not just going golfing and eating nice dinners at restaurants. When you're borrowing to invest, so say you're in retirement and you're still investing, this applies when those borrowed funds are used to generate income. So whether you're generating dividends or rental income or capital gains from a real estate or from securities or from funds or whatever, this is a highly effective strategy to create tax efficient leverage and to reduce your corporate or your personal tax bill and to compound your investment returns over time. Now, whether or not you can deduct the interest, this is not me going to answer that question for you. This is your accountant is going to answer that question for you because I'm not giving you tax advice, especially through a YouTube video. So now, who is the Insured Retirement Plan for? Who's best suited for this? Because this is an advanced financial planning strategy, this is not for everybody. It's best suited for a high-income Canadian. You're incorporated, probably you're either incorporated professional or you own a business and you want to maximize tax efficiency. You want to create flexible retirement income. You've got the sophistication to be able to understand this. It's important for you to leave behind a legacy so you have family that you want to take care of because there is a big life insurance payout. So sometimes we have people that want to set this thing up and they're like, well, I don't want to give anything to my family. This is not a good idea if you don't want the life insurance because the whole thing is based on life insurance. But this is definitely not a one-size-fits-all approach. It works best for those who have a really specific financial profile and a long-term financial planning goal, right? So who does this work best for? Incorporated professionals, business owners, affluent individuals who've already outgrown traditional retirement vehicles, right? Your RRSP has an annual contribution limit. Your TFSA has an annual contribution limit. Our clients are well past whatever those contribution limits are. Obviously take them, but most of our clients need more than that. So if you've already contributed the maximum to your RRSP and TFSA and you have excess cash or you have retained earnings in the corporation and you don't want to take it out personally and you're looking for an alternative that combines that tax sheltered growth, the tax-free access to capital, and the tax-free death benefit payout at the end, this could be for you. You could be a strong candidate. Really, this is the criteria, right? You're incorporated either as a professional or as a business owner in Canada. So this would be things like doctor, dentist, lawyer, consultant, entrepreneur, accountant, software engineer, a real estate investor, and you're earning a significant annual income that's consistent, and you're looking for more sophisticated tax retirement planning strategies. If you have corporate retained earnings or excess personal income and you're looking for tax efficient ways to grow and access this wealth during retirement, and especially if you've already maxed out your RRSP and your TFSA contributions and you need more tax sheltered vehicles so you can continue to build your retirement capital without triggering a huge tax liability now or later. And then you want reliable, predictable, tax-free income in retirement that doesn't count as income. So it's not going to affect OAS. It's not going to affect other income-tested government benefits. And again, this is a big important one. You have to value the estate planning part of it, and you want to leave a tax-free inheritance to your family or to your beneficiaries. Either you're doing this personally or through your corporation. So if you don't like your kids and you don't want to give any money to your whoever, and you don't want the insurance, this is not a good idea for you because this whole thing is based on insurance. And the reason I'm stressing this so much is because we literally have had people who say, I want this strategy, but I don't want the insurance. And you're like, this whole thing is insurance. So not a good strategy for you. Yeah, we've had some people really jumping through hoops to try to figure out how to break this thing down so they don't have to take the insurance. And you're like, do something else. Also, you need to be comfortable with a long-term strategy. This is not a short-term thing. So by long-term, I mean that this involves consistent premium contributions every single year, at least I would say for the first 10 years, because as you're building up this guaranteed cash value, your lending is just going to be so much better in the future because you have more cash inside the policy. The policy accelerates much faster when you're funding it to the max. You're doing what's called max funding or maximum funding. If you're trying to do this on the short term, you want to only contribute a little bit and you want to try to minimize how much you put into this thing and pay the minimum premiums. This is not a good idea for you. This is something where you want to maximize the total cash value and you want to maximize how much you're putting into it every year. So here at Say Pacific, we're typically implementing this for clients. They're usually between 35 to 60 years old. They have this long-term wealth preservation as a core value. Tax optimization is important. They want the retirement income flexibility. Maybe you're a real estate investor, you're a medical professional, you're an incorporated entrepreneur. This can become a cornerstone of your retirement and estate plan without having to rely on the market going up and down and without having to be restricted by government programs that have limits and mandatory withdrawals. So now everything I've said sounds great. What are some drawbacks of this? What could go wrong, right? This is obviously a powerful tool for tax efficient retirement income and for retirement planning and estate planning. It's not a quick fix. It's not a short-term strategy. It's not something that you do if you don't have good cash flow and you don't have good financial habits and you don't have excess cash. It's really designed for higher net worth people. If you're an incorporated, if you're either a professional or a business owner, and you're willing to commit to a long-term financial plan in exchange for significant long-term benefits. So here's really some of the things that you need to understand before you even think about this strategy. So number one, it's not good if you're looking for immediate liquidity or short-term gains. This is a long-term play that requires consistent premium funding, typically over 10, 20, 30 years or more. So if you're thinking of doing this for a year or two and then canceling, terrible idea, don't do it. During these early years of the policy, the cash value grows more slowly. And so your actual cost of the insurance might be higher than what you actually have in cash. So the real benefit is this tax-deferred growth that happens over time, and then your ability later to access large collateral loan values, and then later, this tax-free death benefit. All of this begins to compound meaningfully after years of funding, right? Compound interest takes time. It doesn't just happen tomorrow. To make the strategy work, you need to be financially committed to funding these premiums every single year, whether that's personally or through retained earnings through the corporation. Skipping premiums or underfunding the premiums can really reduce the effectiveness of the plan and it can delay when do you start accessing the tax-free loan part, because the banks want to see loans at a minimum of a certain amount. So you need to hit those thresholds or they're not going to lend to you. Not all insurance contracts are created equal. So the IRP should really only be built using a participating whole life policy or a high quality, sometimes universal life policy, generally not. You want a strong track record of dividend performance. You want stable returns. You want a long-term policy sustainability. Policies that don't accumulate enough cash values, or they don't accumulate it quickly, or they don't have flexibility in how you pay the premiums might not be great for the loan access. And they could fall short of delivering on these results that I've talked about. If you don't set up the policy right, everything I've talked about might not work. Again, this is where you want to work with somebody who knows what they're doing. This is what we do. This is why I'm making this video right now, is because this is what we do and we know how to do it. So you also need the advisor that understands the nuances of how Canadian tax law works, how Canadian tax law changes, how insurance works, how insurance lending works, especially how to use things like the immediate financing arrangement, the insured retirement plan, cash surrender value lending, or borrowing against a corporate policy. Setting these policies up wrong in the first place is very detrimental, because once they're set up, and you haven't funded them properly, if they're set up wrong, they're hard to change. If they're set up right and you do fund them properly, you have tons of flexibility and these things are great. But when you don't set them up correctly in the first place, they might not work. And like the worst thing, this has happened to us a couple of times where people have brought policies that somebody else has designed and you're like, listen, I want to help you, but like you just did this wrong. Like this isn't set up to work. And the last thing that we want to do is cancel policies that have been set up. Like it's generally not a good idea. Sometimes you might have to, but we really try to stay away from it. Also, if you don't set it up right and you don't set up everything correctly, the policies, the lending, your accounting every year, tracking all this stuff, you might actually have unexpected tax consequences. You might not be able to get a loan from the bank. You might set this thing up inside the wrong structure. It might be in your operating company instead of your holding company, or you might be, you just might be holding the policy in the wrong place. And you might want to move it in the future. So then again, that could create tax liabilities. So there's like a lot of things that you need to get right up front in order for this to work. Once it's set up, and if you did it right, like it's pretty simple, but it's getting it right up front. So this is really getting long. So let's wrap this up. This type of strategy, the Insured Retirement Plan, is not just life insurance. It's a powerful retirement income engine that can help you to access tax-free cash flow. It can help you to avoid the RRSP withdrawal traps. It can help you avoid OAS clawbacks. It's especially good if you've already maxed out your RRSP and your TFSA and you're looking for more. You want a smarter, more flexible way to fund your lifestyle in retirement without triggering unnecessary tax. This strategy really like wraps up a lot of stuff. So at Safe Pacific, we specialize in helping high-income Canadians, incorporated professionals, business owners to turn their after-tax dollars into tax-efficient retirement in the future using this IRP concept. So, don't wait until you're 71 to realize that your retirement plan isn't built to last. The way that we can meet and see if this is a good idea for you and to see if we like you and to see if you want to work with us, go to our website. It's safepacific.com. When you get there, there's tons of buttons that you can click to either book a meeting directly into our calendar, or you can send us a message through our contact page and somebody's going to reply to you and we'll set up a meeting. In that first meeting, we really want to understand your situation, understand your goals, understand your concerns, and see if you like us and you want to work with us, and see if we like you and we want to work with you. Like I said, it's safepacific.com. Get in contact with us and we can put together numbers and we can show you how this actually could work for your situation. And if it doesn't work for your situation, we'll also tell you that. I'm not trying to work with people that it shouldn't work with, right? We're not trying to stick square pegs into round holes here. So that's it for me today. If you learned a lot about an insured retirement plan and how it works and you appreciated this, please do me a favor. Do those things that the robots love. Do the things that AI, the algorithm want to see, which is you clicking like, click subscribe. If you have any questions, leave them in the comments below. Hit the notification bell. All of those things help a lot. What really helps the most actually to make these videos go farthest is the engagement, and the way that the algorithms read engagement the most is through comments. So even if you comment, hello, that's great, please do. Or even if you comment the city that you're watching this in, please do. That really helps us a lot, and it helps share this video to other Canadian business owners who are successful, because we are a rare breed. There's not a lot of us, and it's hard to get these videos out to that many people because they're hard to find. So that's it for me today. Thanks a lot for all your help in sharing this video, and I will see you next time.